What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money investing in fractional real estate online as usual. Yesterday, when I was going through these, update on a couple different sites that I decided not to invest in, I just really mentioned or briefly mentioned Landa's Lend platform, which is I think I didn't do a good job explaining what it is again. I just mentioned it and showed that it wasn't doing well. Somebody actually reached out and said, "Hey, what's this about?" That when you look at it, you see, okay, 7.9% interest rate. If I were somebody who was thinking about, bank lending, for example, as far as like if comparing this to a CD or a high yield savings account, that might seem pretty attractive. And I think maybe that's where they were coming from. I don't know, or maybe they thought they could possibly borrow from this platform. But I wanted to explain what it is, and then, just in context of some of the other stuff that I've already looked at, and sort of just compare. So Landa has this Lend, Arrived has their private credit fund. Groundfloor is a similar platform in general, but specifically they have the Flywheel portfolio. I think those three things make are the most comparable. So we've got Landa, we've got Arrive Private Credit Fund, yeah, and the Flywheel portfolio. So Landa's Lend, what it is, and I'm just this is all just information I'm compiling from their individual websites. There might be some details that are left out. Like if you're going to invest in any of these, you want to do your own due diligence. Actually, look at their platforms, read the circulars. All three of them do a good job of providing a ton of info. If you really dig into their frequently asked questions and you look into the offering circular, you definitely don't just want to look at one page, see the price per share, and jump in on that. And so the first three are all mortgage REITs, as far as I could tell, looking at their information. And what is that? That is basically it's a single entity that is either making the loans themselves, which is what I think Landa is doing, and what Groundfloor is doing. The Groundfloor makes the loan and then moves them into the Flywheel portfolio. Arrived Private Credit Fund, it sounds like they're buying them from a third party, although it could be a related party. I wasn't able to actually figure that out. Um, so all three of those are holding, is a single entity that's holding multiple mortgages. Ground Floor also has the option of, well, I'm going to talk about Ground Floor's individual loan option last. It's what I've opted to do, and I want to explain why. And I think it works best once you get the context of what the other ones are doing. And so, I just want to go through, what's the underlying assets. And so for Landa, if you dig into, they talk about, okay, they have currently 9 loans outstanding. They show you where they are on the map. They're all in their main market. That doesn't, that's not super surprising. They're actually loans that were made to some of the properties owned by Landa, right? So if you own Landa properties, some of them have, if you invest in Landa properties, which I'm assuming you know what Landa is, but maybe that's not a great assumption. It's a platform where you can buy fractions properties, and all of those properties are, run by the Landa company. They might have different third-party managers, but the actual operations, the decision making happens by Landa. And so some of those properties, when you buy them, have third-party mortgages. Some of them have, 9 of them apparently have these mortgages from their lend fund. Um, Currently, the interest rate's 7.9%. I'm going to get into what that is in a minute, but I just wanted to say, and so those assets are all interest-only adjustable rate mortgages. For the Arrive Private Credit Fund, I want to get into what that one is. Again, I think this is, they're saying they pay consistent 8.1%, but when you dig into what they're doing, they are primarily the loans on here are, I think I had it on there and then I scrolled up away from it when I first got here. But what they're investing in is real estate debt, but it's debt that is for, it's short-term debt for rehab loans, new construction, and they say anywhere from 6 to 36 months, somewhere on there. So that's what they have. And then the ground floor flywheel portfolio is all ground floor loans. And those are made up of, again, those are mostly fix and flip loans and new construction. And so, as far as I understand, they're all first mortgages. There might be some exceptions to that where, so, where they're sometimes doing seconds or something, but that's how I understand it, is they're primarily first mortgages. The big difference is for Landa's, it's basically like, first mortgages for investment properties, not necessarily bridge debt. It's not for the construction. It's for properties that exist out there, and it's part of their capital stack. Now, because it's an adjustable rate mortgage, my guess is they're using it to stabilize properties. But I couldn't actually find details about the individual loans. So that interest rate stated is actually the interest rate on the underlying mortgages. And so, or on some of them, on the new one. And so if when I dug into what their interest rate means. So it's a floating rate. Currently, they're just doing 3.5% on top of the secured overnight financing rate. And that rate is a rate that you can actually look up. Let's see, what am I on here? Nope, that's not arrived. On the Fed's website, and I'm actually just looking at the New York Fed, but I believe this should not vary from one place to the next. And so today, if you looked at, what's that rate? Really, we don't have today. So the last one I can see on here is a couple of days ago. I wonder why that is. Friday. This might only actually be given 12, 13, 14, 15. Yeah, I think they're probably skipping weekends, right? I think it probably only gets shown on weekdays, but I'm not positive about that. But so basically, what happens is you take this number and you add it to their spread, and currently their spread is 3.5%. Although they talked about some of their older loans, they were just doing only 2% over that rate. And so if you look at the portfolio as a whole, the blended rate's going to be lower um, than 7.9%, because some of them are at 2 plus 4.3, so 6.3% right now. So they're just telling you, what's the interest rate of the underlying asset when you look at this and see that. Where do we see that? That's 7.9, and they say that, right? This is the rate of the loan payments. Um, oh, that's interesting. So this says this is the weighted average from the October dividends. That doesn't seem. I'm not positive that that's accurate, but maybe it is, because you can see there's a big dip in dividends. There was either a repayment or some of the loans aren't being paid. This is one of the reasons that I haven't been putting money, or that I took my money off of Landa, is they don't do a great job answering questions, customer service around, like, when you're trying to figure out, okay, what really happened here, right? You get just very vague answers whenever I've asked them, what's going on. The only thing that they actually gave me definitive answers on was when I took my money out. When it got stuck in there for 2 months, they were able to explain to me why and whatnot. But so this could be the actual blended rate of what's on there, but that would lead me to believe that, of what paid anyway. Um, the average weighted interest for October dividend. Interesting. But in any case, for me, when I was comparing it against all of these, I don't find it to be very compelling, and it's part of the reason I didn't invest in that. If you look at Arrived Private Credit Fund, they state that they're, this is their expected annual dividend yield is 7 to 9%, but I believe I also found somewhere, and that's what they're saying they're planning to pay out after fees. So maybe that. I'm not sure where I saw that. I'm probably giving you a ton of terrible info today, right? I'm sorry about that. Targeting higher yields, 7 to 9% dividends. I know I pulled that from somewhere from their interest rates. Um, hmm. In any case, they're paying out 8.1, which is, fits somewhere in between there. Currently, that's what they're doing for, and this is going to be a thing. I'm going to show you the flywheel one. I'm going to tell you again. So they say currently that they have, their mortgage loans or their loans are all between 9.5 and 13.5%. I'm using 9.5 to 14.5%, because when I did the other time, it showed me that higher percent. And I know I've had some mortgages in here of that higher percent. Now, maybe today they don't, and that's why they've moved it back down. And that's one of the things for all of these portfolios. Um, their actual loans in the portfolio should change over time. And so, even if you look at what it is today, especially in a where rates are changing pretty rapidly, what they pay today doesn't necessarily mean that's what you're going to get paid over the long run with these. Both of the Arrive Private Credit Fund, like I said, they were like 6 to 36 months. Ground floors tend to be 18 months or less. Landas were adjustable rate, and I didn't actually see timing on them. And so I think those are intended to be outstanding, possibly for longer periods of time, but it's an adjustable rate. So as that index moves, right, as this secured overnight financing rate moves, this rate that you get paid out will change. So I'd expect that to continue to shrink if rates go down, and to increase if rates go up. So it could be a good thing or bad depending on what happens. The others, because they're going to be, at any given time, your dividend in these is going to depend on what loans are actually, moving through the system. Again, you can have higher or lower rates, but they'll be a little bit lagging, right? They're not adjustable in the same manner where the outstanding loans change. But what will happen is the newest loans that go into the pool might be different, will be priced different over time. And so, when you look at all those, to me, like so far, it seems like the ground floor flywheel portfolio is a no-brainer out of all these. Of course, there are reasons that you could look at when looking at all these companies that you just make a different decision. You might think, so one of the things is they are all underwritten by different companies, right? And so I know a lot of people like Arrived. They're buying the Arrived homes um, for what I think of as terrible yields, but they're doing it because they trust what they keep saying is it's a Jeff Bezos backed company. And so they have a lot of faith in the company itself. And so because of that, a lot of investors seem to be willing to take a lower yield. And I think the same thing is happening in their private credit fund, right? Like, I mean, if you're getting 8.1%, but it's backed by a company that you're pretty excited about, that's a little bit better. But so, how liquid is this investment, right? What's the lockup? And each one of these, the answer is a little bit different. For Landa, they're using, let's see. Oh, did I get rid of it? No, okay. They're using this basically a redemption rate breakdown. So like if you try to cash out in the first 12 months, you can't. In the next 3 years, you're going to get 97% of the current share price. So if the share price has gone up, you're making money. If it's gone down, you're losing money. Um, it looks like, so I remember they were originally $10, and so now they're $7.21. So it looks like people have already lost money on these, and uh, on top of that, you lose an additional 3%. And then in years 3 and 4, it goes down. In years 4 and 5, it goes down. Then as long as you leave your money in there, you get 100% of whatever the current share value is. And so that share value is going to vary based on the net asset value of the loans. Um, I'm not really sure what's caused that to go down. So I don't know if they had some bad loans or if they've paid out. Um, it's possible that they're paying out principal, and so that's lowering the net asset value. I'm not sure about that. And that was one that I didn't see an answer to, but let's actually look again at how they pay out the dividend. Yeah, because they're only paying interest only, so it wouldn't make any sense unless there was just a repayment of principal in whole. But even that it says I don't believe, right? These are the days. Yeah, so it's just the operating income minus expenses. So there's no discussion of of any sort of principal payout. So I'm not really sure why that mortgage or why that price has gone down. It doesn't make a lot of sense to me. It's again why I'm a little bit leery, of these things. Arrive Private Credit Fund is doing something similar. Let's see. This, they have for 6 months, no redemption period. For the first, 6 months to 1 year, they charge you 2%. For 1 to 5 years, they charge you 1%. Now they're paying back percent of total share value. So I believe it's going to work the same way. Although I didn't see on theirs where the actual share values were today versus in the past. And I haven't been watching them. Yeah, their share price is $10. But I think that so far it's just always been $10. Um, I hope I'm not confusing these two, but I believe that they both started at the 10. And so, one of the things that you'll see is they really are, there's nothing new, right? There's no new ideas. And a lot of these, they are aware of each other and they're trying to compete against each other um, in their own way. And, and I mean, I think it's no secret that they have pretty similar redemption penalties, right? And so it's not, they're neither of them are making, reinventing the wheel. Although, and I no pun intended, but I think Groundfloor is a little bit with their flywheel portfolio. So, as far as I can tell, you can't sell it at all. I don't believe there's any redemption. But what they're doing different is your payouts are so as the loans repay, you get both the principal and the interest back. And so if you hold the portfolio through the typical repayment period, the 18 months, you're going to get the vast majority of your money back. And so you have the ability to reinvest the principal, but it's not trapped in there. And I think that's why it makes it significantly different, right? You don't have this money, you don't have the principal trapped in there where you can't, where you're getting a penalty to redeem it. You're actually getting paid out your principal and your interest. Um, when they do talk about, you do have a fee for that. Um, they're actually really transparent about exactly what it is. It's just 1%, of the total loan value, total portfolio value, uh, paid quarterly, so a 0.25% every quarter. So that's significantly different, right? You're not paying a penalty, but you're not able to, redeem that money any earlier. But because all of their loans are relatively short term, um, if you hold that to maturity, you should at least get the vast majority of your money out within that first 18 months without a penalty on the principal. Now, the downside is you have to decide up front, am I reinvesting that money or not? So if you're continuing to reinvest, then at any given time, if you want to get that principal out, you're not going to get it out until, sometime up to 18 months in the future. Um, and so one of the things, the reason any of these might be attractive is, okay, I'm getting an interest rate and I'm trying to get diversification, right? Like that's why you invest in a REIT instead of just doing private lending on your own. And so that's one of the things that for me weighed really heavily against Landa and Arrived is you're just not getting a ton of diversification, right? Like for Landa, they have a total of 9 mortgages and they're all in the same market, right? And so you're getting virtually no diversification there. And they're all the borrowing entities are entities run by Landa, right? And so I really didn't like that. Um, for the Arrived Private Credit Fund, they just say we currently have 44 loans. Um, I'm not sure. I think if you dig into it, you might be able to get some detail as far as where they are geographically. But 44, you're starting to get some diversification. But for me, when I look at the difference in what I'm getting paid, uh, you know, I for 8.1% yield, I want to know that that's really secure, right? Because when we compare that to some of the other deals that we talk about on this channel, I'm not super excited about that type of return. And so if I want to get that, I want to make sure that it's really solid. And so I want to be able to spread my risk very, very widely. So, it's 44 is a lot better than 9, but it's still not extremely wide diversification. And then for Groundfloor's Flywheel portfolio, the last time I could find a number, it was 267. Today I didn't see a number anywhere, and I know they're constantly putting, you constantly putting new loans in and taking them out. So I just put over 250. It's some number, um, you know, that I don't know the exact answer at any given day, and my guess is they don't publish it because it's changing constantly. Um, Although maybe if you do the view reporting, I don't know. There's always no, let's see. Oh yeah, actually look at that. I didn't click into the investments tab. Oh, well, this is looking at my particular, and I haven't bought any of the flywheel portfolio because now I'm going to tell you about what I actually am doing. So for the debt side of investing, I'm primarily experimenting with ground floor. I think that it is um, superior to the other options that I've had. And the other options that I just talked about. And so let me show you what I'm doing with this. And, just like always, just because it's the choice I make, it doesn't mean it's the right choice for you. You should do your own due diligence. But I want to talk about, what I'm doing and why I chose to do this instead of the flywheel portfolio, or which I think if you're looking for that set it and forget it, just put the money in one time. Out of these three, options that we talked about, I think the ground floor flywheel portfolio, it seems superior to me. I haven't invested in any of them, and I don't have none of them have a very long track record at all, and so it is. Who's actually going to come out on top is yet to be seen. And so again, as usual, do your own due diligence. Now, Ground Floor has been operating with these individual loans for a very long time. I think, well, very long relative to everything else. They've been doing this over 10 years, where you're basically buying pieces of loans that they've originated. And so instead of me going in and picking, putting money in and they just spread it out across all of their loans, I can go in and actually pick individual loans. Now, I am still just picking to spread some amount into each loan that they originate, so it's a little bit silly, but I'm doing it to avoid that 1% fee. So you pay less fees if you just do it yourself. The downside is I don't have as wide diversification right away, but I'm getting there. And so what I'm doing, I go on the invest tab, and I've just picked an amount that I'm putting in, and I have different amounts in these two for some reason, or in a bunch of them actually. Oh, because as I get repayments, I'm spreading them out back into them. But so whenever loans come up, and there's a whole new batch now, and so I'll just take a lump sum of money, I'll spread it evenly across all of those, um, and then over time, so far, I've done that for 82 loans. 9 have already paid off. 73 are still outstanding. And the reason I like to do it this way versus just sticking the money in the flywheel portfolios, like I said, I mean, all I'm doing is avoiding that 1% fee. Um, so far, like just like all of these platforms, I'm very much still in an experimenting with them stage. You can see my blended rate that's expected is 11.3%. But I do already have one of my loans. Let's see, that is in trouble, and it's currently in the extended workout agreement in place or in progress, right? Which means they don't expect to pay on time, although it's really early. So what I think is going to happen is they're going to pay. Um, they're trying to pay less because they ended up to where they're not making money on their flip, and maybe not even enough to pay for the loan. So that's, so it looks like there's already one that I've got that might end up with a loss of capital situation. I don't think it's going to be a complete loss, but I think it's going to be enough that it's going to hurt my actual rate over time. But so far, my payout on all the ones that have paid have actually turned out to be 11%. One of the things that's really interesting about it is you just don't know when they're actually going to pay off. Some of them paid off in just a few days. I had the rest of these 9 probably were, so probably 7 or 8 were somewhere around a couple months time frame. And then the rest, it'll be, it's to be determined when these are going to be, but expected, sometime in that 18-month time frame. And if you think about it, it makes sense. For a fix and flipper, they took out that loan, they closed on the property. Some of them might have just decided, I'm just going to sell it how it is. I just wanted to take down the property with debt, and then maybe I just cleaned it out and sold it to another flipper right away. And then some of them might have just done a little bit of work and then put it up for sale, and then it sold. And then some of them are doing really major rehabs. And you can actually look into, before you buy each note, what the, a lot more details about the location and whatnot. I don't think I have. I definitely have info on how geographically diverse these are. I don't remember how to get to it on here. That's one of the things, it's not the most user-friendly website, but you can see, so right now, even just buying these myself, I have significantly more loans, right, than what Arrived has. Arrived and Landa put together have less loans than what I've just picked up over a couple months of investing on Groundfloor, and I will just keep picking more of these up. If you've watched a lot of my other videos where I talk about debt, you'll notice that Lofty's debt product is, left out of my spreadsheet, and I'm not giving you a lot of detail. I want to explain what's going on there, just in case you're wondering. They have this universal lending DAO, which it's not mortgages. It's actually it's lending to the other entity platform. But it does have some security in that it's not a true security interest like a mortgage, but it is, you get some ability to liquidate those, to liquidate the other entities if they're not paying you back. There's obviously terms involved, but the reason I'm not is there's actually some accounting problem happening with the Universal Lending DAO right now. It seems like they were paying out principal and they didn't realize they were paying out principal, or some people at the company did and others didn't. And so the way it was reported was really off. And so they're doing an internal audit at the moment, is what I've been told. And once they have it figured out, they're going to let us know, and they said if if it turns out that they've done something wrong, they're going to make it right. But so I guess one of the things I should do is just go through real quick, what is different here. These are LROs, which is just like pieces of the individual mortgages versus a whole REIT. It is the same types of loans that are in the Groundfloor Flywheel Portfolio and similar to the ones in the Arrived Private Credit Fund. The spread on the rate seems to be the same as what's the rates on the Flywheel Portfolio. It makes sense because I think the Flywheel Portfolio is really trying to buy one of every piece that goes into there. The same thing happens with the lockup, right? Like I can't sell these LROs. I can't sell these individual investments in any way. I'm just waiting for the loans to get paid back, and I just get paid the principal whenever that happens. And so for several of them, like I showed you, it happened very quickly, right? More than 10% have paid me back already, and it is, I've only been doing this for 3 months, maybe 4 months now. So it's still relatively new. But so that's how you get your principal back. And then the other thing, as far as diversification for this, it's really up to you, right? Like you can go in here and like look at the details of the individual mortgages, decide that you only want to pick ones in certain states and certain areas if you wanted to. For me, because of how similar the product is in that it's all underwritten by the same people, I've decided that I just want a little piece of every single one. I don't want to be trying to guess which ones are going to go bad. I just want the blended rate of everything that they have out there. Get some really wide diversification, both geographically and across properties, and even across the different, the different borrowers, because they have some borrowers that have multiple loans. So there's a lot of reasons. I've just decided I just want a little piece of a bunch of them. Again, it might not be the decision that you come to. You might look at them all and say, hey, you know what? I think I just want to pick and choose which ones I borrow, and I think that's fine too. Um, that's really all I want to share. So because at the moment, these are all the different places that I'm aware of that you can just buy little pieces of debt or that you can invest in debt on these fractional sites. Now, one of the things, though, is if we look at these REITs, they're all when you start to think about it, they are mortgage REITs and they're just private mortgage REITs. So you just go to the individual platforms to buy and sell them. There are tons of publicly traded mortgage REITs out there that if you were going to invest in any of these three products, I think it makes a lot of sense to just look at what the publicly available ones are out there. Because let me just pull up one that I just happened to, let's see, I think I know. Is it? No. Yeah, Annaly Capital Management. Um, just so these are my, oh, it's one of the largest mortgage real estate investment trust. Yeah, so this is a large mortgage REIT. It's one that I've invested in the past. I'm not telling you that this is one that makes sense for you or not. If you look at it, it has a very high dividend yield. Um, if you look at its performance over a long period of time, though, the price moves. Well, this isn't actually terrible compared to when I had owned this, but it's a volatile price over. Although if you look at the last several years, I guess even though it fluctuates a lot, it's not horrible compared to how it had been at different points in time. But so if all you're doing is looking for yield, and I'm not saying this is the one, but there are several public mortgage REITs out there that you could look at. You get paid a dividend. And I think that is, if I'm looking at Landa, Arrived, Groundfloor's Flywheel Portfolio, now I'm no longer buying, individual fractions of loans like what the intended purpose of me going on. So for example, when I go on Landa, I'm looking to invest in fractions of homes, right? Like I'm looking on fractions of home equity. So you would think the core, the analog on the debt side would be being able to buy little pieces of debt, but that's not what we're doing here, right? We're buying into a little piece of a fund that owns lots of little pieces of debt. Now, maybe that doesn't matter to you, but once you start to get to that fund or REIT level, where you're, getting bunches of mortgages, you really have to stop and think about, am I getting a real advantage over just buying, publicly traded mortgage REITs? And honestly, for me, the answer is I don't know, right? One of the things that I find very difficult when looking at REITs in general is figuring out, what is going on inside that portfolio, what the expenses are. Um, and that's why, for me, I've decided to just continue to invest in individual pieces of mortgages through ground floors, buying their individual loans on there. Is so that there's no time that there's going to be some hidden fee that I don't understand, or that there's going to be some like salaries for directors or of the REIT itself. There's all these. The more it becomes an entity and not a piece of a deal, the more potential there is for layers of expenses to be added on, or layers of complexity that just make it hard to analyze. And so that's one of the reasons that in general I've been buying the fractional real estate versus buying into REITs that own a bunch of different real estate, is because I want to be able to make decisions and truly understand what my underlying asset is. And the more you just sort of start to push a bunch of this stuff together in clumps. You might be getting better diversification that way, but you're getting, it's becoming very opaque. It's becoming difficult to look at and just see what what you really have. And so that's why I haven't gone in that direction. Um, it certainly doesn't mean that it's not the right, decision for some of you. And maybe it is, if you're looking for something that's just truly passive, I mean, that's as passive as it gets, right? Where for what I'm doing on ground floor, I'm going in here, every time I get an email that a loan pays off, I have to go take the capital and redistribute it over whatever is open at the time. For me, I like doing this. I like paying attention to what the money's going into and whatnot. But it might just not be what you're into. It's also, um, I understand how ground floor makes money, right? Like they are charging origination fees on this debt that gets paid for by the borrower. They're not charging us a fee on the loan itself, right? Like whatever that interest rate is that's being collected, it's getting paid out to us as the owners. And so it's always really clear to me, what my specific return is, where it's coming from. Where when I'm looking at, once we start to group properties together and have some expenses and um, within the entity, it just the and I guess I should give you a little background. The reason that I am so skeptical of this, I started my real estate career working for two different public REITs. My first two jobs in real estate were working for public REITs, and both of them had significant expenses that and they both had very large portfolios. But if you looked at, like, anytime I think about like investing, I think about the Christmas parties we had at some of these. Like we had these giant lavish parties, and this was during boom times. But it is that money came out of investors' pockets, right? That were buying to get the access to um, the yield on these properties, but some of that yield has to go to pay. And I'm not saying that the employees, that we shouldn't have, the benefits that we had working there, right? Like part of it is becomes competitive, and you have to do that, especially when real estate's doing really well. But at the same time, if I had owned a little piece of each of those properties instead of owning the pool, we might have been paying, outside managers and whatnot. But it is, at a minimum, it would have been a lot more clear, where that profit and loss was coming from. You wouldn't just have these, you could just end up with large expenses that have nothing to do with the property itself. Once you start clumping things together, and so that's why I really don't like that. Um, and sometimes it's really clear, and it should be, if you look at the circulars, you should be able to figure out exactly what you're being charged. And then for the publicly traded ones, you just have to pay attention. You need to read the financials they put out, the K1s, everything. And for me, I won't invest in a stock or anything unless I'm actually doing all that research. And so then it stops feeling any more passive than any of the stuff I'm doing now. I think now I've definitely gone way off on a tangent, like I always do. I really just wanted to clarify what that Landa Lend thing is, because somebody did ask. And then just kind of compare the ones that are out there that I'm aware of, and let you know which option I went with and why. But anyway, I always forget to do this until the end. If you don't mind liking and subscribing, that would be fantastic. I have links in the description to Ground Floor, if you want to take a look at that, if you haven't already. Um, and that's it. I think that is everything. And so until next time, I'm going to keep making mistakes so that you don't have to.